Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The fall in the US dollar accelerated at the start of April, as the shock of trade tariffs caused capital flight from US assets. We don't know yet how long this trend will be. In finance, it is often said, America sneezes and the world gets a fever. Even if the problems originated in the US, the impact on the markets of other countries will be more substantial. The dollar index moved sharply below its previous support, confirming the prevailing downtrend. The technical target of the current drop now looks like the area from 99 to 100. The lower boundary represents the Fibonacci extension of the first impulse. The upper boundary passes through the psychologically significant round level, which stopped the dollar's decline in September-October last year. Among the dollar's competitors, the euro and the yen are the biggest gainers so far. These are the next two largest capital markets after the dollar, where investors are hoping to weather the storm. The euro returned to local highs against the dollar and the pound. Euro USD has also been near the upper boundary of the trading range for the last 3 years, and it is ready to break it and move further up. The tariffs announced by Trump were tougher than expected, and were not immediately followed by talks on easing them. This triggered a negative reaction in stock markets around the world, including the US. An important barometer of sentiment, the Fear and Greed Index plummeted to 8, to a 3-year low. This is considered a time for bold buying. However, it is more prudent at times like this to wait for the indicator to move back from the extreme fear zone below 25. The S&P 500 moved to renew multi-month lows after consolidating and rebounding in the second half of March. The technical turning point was the touch of the 200-day moving average near 5,800. This level also coincided with a corrective bounce to 61.8% of the decline from the second half of February. A decisive affirmation of the downtrend opens the way to the 5,100 area, taking the US market back to the lows of last August. There's a very similar technical picture in the NASDAQ 100. On the recovery to 20,400 at the end of last month, momentum lost strength. The 200-day moving average and 61.8% of the first impulse of the fall, which started in late February, are concentrated near this level. The dynamics of the last 2 weeks showed and confirmed that the key US indices are moving within the downtrend. The turning point in such situations comes only sometime after aggressive monetary policy easing. Tariff shocks, elevated inflation expectations, and full employment may tighten the Fed's hands. Movements in metals have been monumental. A 3% rise deep into the region of all-time highs for gold was followed by a collapse of more than $100, from $3,170 to $3,050 an ounce. On Friday, trading stabilized near $3,100, minimally adding to levels at the opening of the week. Tactically, this is a good time for the bulls to exhale and lock in profits. This is confirmed by the fulfillment of an important growth target and the entry into extreme overbought on weekly timeframes on RSI. Multi-week corrections started in similar conditions in 2024. Oil took a double hit in less than 24 hours when the macroeconomy pressured it due to tariffs and OPEC Plus actions. Tired of waiting for the global economy to accelerate, the cartel switched gears in the battle for market share, pledging to ramp up production faster than the previously announced plan. Similar moments occurred in March 2020 and December 2014. On both occasions, oil dipped below $30 a barrel, before finding support in the form of coordinated action by global producers. In theory, coordination is now at a higher level, but that doesn't negate the powerful pressures expected due to the trade shock and supply expansion. Technically, oil is breaking through the bottom of the 3-year range, and the 50-week moving average worked as resistance for the third time since September. The crypto market cap fell below $2.65 trillion twice during the week. The market was below the $2.60 level in November. The ability to consolidate above it was an important signal for the start of the rally. The market will likely defend this, which promises a prolonged battle near these levels. However, the balance is now on the side of the bears, as the capitalization index is moving away from its 200-day average. This is an important signal for large funds to reduce their investments in the sector. Bitcoin jumped to $88,000 in reaction to the tariff announcement, only to soon fall back below $82,000. In the short term, it looked like another wave of selling to the upside. We have been seeing this trend since the second half of February. Technically, this is a continuation of the struggle with the major moving averages. The market is failing to consolidate above the 200-day MA, and the 50-day MA stopped rising intraday on Wednesday. As much as crypto enthusiasts would like it to be otherwise, the bears are in control of the market for now. Trade tariff news will be the defining news in the new week, and central among scheduled events will be U.S. inflation figures. On Wednesday, the Reserve Bank of New Zealand is expected to cut its key rate by a quarter point to 3.50%. For the fifth time this cycle, extending the overall cut to 2 percentage points. March U.S. consumer price data will be released on Thursday. The annualized rate of overall inflation has been hovering just below 3% for the past few months, but a jump in inflation expectations and manufacturers' inflation estimates point to mounting pressure. If this starts to materialize right now, it will greatly complicate the Fed's puzzle. Producer price data, a leading indicator of final prices, will be released on Friday. The growth rate is above 3.3%. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.